Imagine for a second that you are sitting on your couch. It's, I don't know, 9:00 p.m. You pull out your phone, the screen glows, and you open an app. Maybe it's Amazon, maybe Flipkart, maybe Zepto.
Usual suspect.
Exactly. You scroll for a bit, you find, say, a pair of noise-canceling headphones or a bag of artisanal coffee, and you tap buy.
It's the modern ritual, isn't it? We do it without even thinking.
We do, and it feels like magic. It really does. You tap a piece of glass, and a digital signal just shoots off into the ether. A few hours, or maybe a day or two later, a physical object, a box, appears on your doorstep.
But it's not magic.
It's not magic, and that's the thing that, well, not keeps me up at night, but it's the thing I think we all just completely take for granted. Where does that object live in the in-between?
The limbo state, the physical limbo.
Exactly. Between the factory in, say, Shenzhen or Tamil Nadu and your front porch, where does it sleep? It's not floating in the cloud. We talk endlessly about the digital economy, about the software, the AI algorithms predicting that I, want those headphones.
Right.
But today, I want to talk about the hardware. And I don't mean silicon chips. I mean the invisible infrastructure that actually makes the modern economy physically possible.
The concrete shell that houses the entire tech economy. You've hit on it.
That's what we're doing today. We are doing a deep dive into the unglamorous, heavy, massive world of industrial warehousing. But more specifically, we are looking at how a regular person can actually own a piece of this critical infrastructure. Today, we are dissecting the NDR InvIT Trust.
This is a fascinating topic because it sits right at the intersection of two very, very different worlds. On one hand, you've got old school real estate, bricks, mortar, land, steel. It's tangible.
The stuff you can kick.
The stuff you can kick. And on the other side, you have the explosive, high-tech, fast-paced growth of logistics and e-commerce.
Yeah.
NDR InvIT is the vehicle that tries to bridge that gap for an investor.
Okay, so before we get into the weeds, and believe me, we are going to get deep into the weeds on this, we should lay out our sources. We have a whole stack of documents here. We've got draft placement memorandums, which are always fun to read.
Very light reading.
Investor presentations for the last couple of quarters of FY25, a pretty detailed credit rating report from CARE, and a bunch of dense industry analysis on the Indian logistics sector as a whole.
So we have the company's story, and we have the third-party view.
Exactly. And our mission today is to take this mountain of data and distill it into a really clear picture. We need to understand the investment thesis, the competitive moat, the risks, and there are definitely risks, and crucially, the mechanics of how a giant box of concrete actually generates cash for you, the unit holder.
We should probably start by clarifying what an InvIT actually is, because it sounds a bit like a nasty tech virus or something.
It really does. I caught an InvIT.
It stands for Infrastructure Investment Trust. And the easiest way to think about it is like a mutual fund. But instead of the fund buying stocks in companies like Infosys or Reliance, the fund buys physical infrastructure assets. That could be roads, power lines, cell towers, or in this specific case, warehouses.
And there's a key difference between this and just buying a normal company stock, isn't there? It's about the cash.
Precisely. The regulation is the key. An InvIT is structurally designed from the ground up to be a yield machine.
Because they have to pay out the cash, right? They can't just sit on it.
They literally cannot. By law, they are mandated to distribute at least 90% of their net distributable cash flows to their unit holders. Now think about that. A normal tech company might make $1 billion and decide to keep all of it to build a spaceship or buy a competitor.
Or just pile it up on the balance sheet.
Right. An InvIT can't do that. If they generate cash from rents, they have to write you a check. It's a legal obligation.
So it's a pass-through vehicle?
It's the ultimate pass-through vehicle. It passes the cash from the tenant who's paying rent straight through to you, minus, of course, the management fees and the upkeep.
Okay, so that's the vehicle. Now let's look at the engine. The subject today is NDR InvIT Trust. So if you had to summarize the elevator pitch for this, the core investment thesis, without using, 5-syllable finance jargon, what is it?
Simply put, NDR InvIT is a bet on the formalization of the Indian supply chain. It's a way to own a high-quality portfolio of 33, I think, operational warehouses, which covers roughly 16.91 million square feet.
16.91 million square feet. That number is just so big, it's abstract. Can you put that in perspective for us?
Sure. Think of about 300, maybe 310 full-size football fields all stitched together and covered with high-tech steel roofing. It's vast.
Okay, that helps. 300 football fields.
And the core thesis is what some people call the best of both worlds. On one side, you get the stability of rental income.
Yeah.
Because these tenants, Amazon, Unilever, they sign very long leases. That gives you regular cash flow, which acts a bit like a bond.
Predictable.
Very predictable. But because it's real estate, you also have the potential for capital appreciation. As land values in India go up over time, the value of the underlying asset, the land itself, should also go up.
So it's a landlord business, but on a massive industrial scale. But this is where I want to pause and push back a little. Buying a stock is easy. Trusting a management team is hard. Who are these people? You don't just wake up one day and own 17 million square feet of warehouses. There has to be a story here.
No, you don't. And that's the first real pillar of the thesis, the lineage. The sponsor, that's the legal term for the entity that sets up and backs the NVIT, is NDR Warehousing Private Limited.
Okay.
And they aren't new money. These guys have been in the warehousing game for over 3 decades, and the group they belong to has been in logistics for something like 6 decades.
So they were doing this long before it was cool, way before e-commerce was even a word.
They were doing this when a warehouse was just a go-down, a shed with a big padlock on it. They've seen the entire evolution of the Indian market from the ground up.
That's a huge advantage, that institutional memory.
It is. But, and I think this is the part that probably caught your eye in the reports we were looking at, they aren't doing it alone anymore.
You're talking about InvestCorp.
Yes. This is what I call the smart money sector. InvestCorp is a major global investment manager. We were talking about, $50 billion in assets under management? These are heavy hitters.
They're not a small shop.
Not at all. And they led a $55 million investment into NDR and then helped with a subsequent $61 million fundraise. Their presence is a huge validator.
Okay, let's play devil's advocate for me here. InvestCorp is huge. Why NDR? There are bigger players in the Indian market. You've got Blackstone, you've got ESR, you've got Indospace. Why did a global giant bet on what is essentially a domestic family-run business? Is it just because they got a good price?
That is absolutely the right question to ask. Because look, big PE firms make mistakes all the time. But in real estate, especially in a market like India, local knowledge is the ultimate currency. You can have all the billions in the world sitting in a bank in New York. But if you don't know how to navigate the complexities of land acquisition in a village outside of Chennai, you're dead in the water.
You can't just buy a 50-acre plot on an app.
Not a chance. NDR has the land bank. They have the local relationships with government, with landowners that go back 40 years. InvestCorp likely saw a company with fantastic, well-located assets, but maybe one that needed a layer of institutional governance and, of course, capital to really scale up.
So it's a symbiotic relationship.
It's the classic local operator meets global capital story. NDR gets the cash and, just as importantly, the global stamp of approval. And InvestCorp gets access to a pipeline of prime assets they could never hope to build themselves from scratch.
And that validation is crucial for a retail investor, I guess. It tells you that someone with a very sharp pencil and a whole team of lawyers has already torn this company apart and decided it's clean enough to put over $100 million into.
It de-risks the governance question to a large extent. Yes.
Fair enough. So we have the vehicle, the NVIT, we have the operators, NDR plus InvestCorp. Now I want to look at the history, because you mentioned they've been around for decades. But this idea of a modern, massive warehouse is a relatively new concept in India. Why is this sector booming now? Why weren't we having this conversation 10 years ago?
To understand that, we have to talk about a really boring but utterly revolutionary piece of legislation, GST, the Goods and Services Tax.
Oh, boy. Taxes. The most exciting topic in investing.
Bear with me, because this is probably the single most important macro factor in this entire investment case. Before 2017, India's tax system was a fragmented mess of state-level levies. You had VAT, octroi, all sorts of things.
Right.
So if you were a company like, say, Unilever or Samsung, and you wanted to sell your goods in 20 different states, you effectively needed a warehouse in every single one of those states to avoid paying double or triple taxes as your goods crossed borders.
So wait, you had to have a tiny warehouse in every state just for tax compliance, not because it made any logistical sense whatsoever?
Exactly. Your entire supply chain was designed by your tax accountants, not your logistics experts. This led to thousands upon thousands of tiny, inefficient, frankly crummy little go-downs scattered all over the country.
It sounds incredibly inefficient.
It was a nightmare. Then GST kicks in, one nation, one tax. Suddenly, India is one single market from a tax perspective. You don't need a warehouse in every state anymore.
You can consolidate.
You can finally consolidate. You can build one massive grade A mother hub in a strategic location somewhere central like Nagpur or near a major port like Chennai and service half the country from there. That single shift from fragmentation to consolidation, created the explosive demand for these massive 500,000 square foot facilities that NDR builds.
So this entire asset class in its modern form is basically a child of the GST reform.
It is the direct result of that reform. Without GST, we wouldn't be seeing this boom.
That makes a lot of sense. The regulatory unlock created the physical demand. So let's talk about that physical demand. We keep using this term, grade A warehousing. In the reports, they make a huge deal about distinguishing it from grade B or generic warehousing. To the uninitiated, myself included to some extent, a warehouse is a warehouse. It's 4 walls and a roof. Why does grade A matter so much? Why is it an economic moat?
This is where we need to get a little technical because it's crucial. If you drive past a grade A facility, you're right, it just looks like a big metal box. But inside, it's an engineering marvel. Let's start with the most important part.
The roof.
The floor.
The floor. It's just concrete. How complicated can it be?
It's the most expensive and the most critical part of the entire shell. We're not talking about pavement concrete. We're talking about floors built to FM2 or FM3 global standards.
Okay, you've got to translate that for me, FM2.
FM stands for floor flatness. FM2 refers to the flatness and levelness tolerance of the concrete. These floors are poured using laser-guided screeds. They have to be leveled to a tolerance of less than 2 millimeters over a 3-meter straight edge. It is unbelievably flat.
Why on earth do you need a floor that's pancake flat? You're just storing boxes of soap on it.
It used to be just for soap. But today, if you are Amazon or Flipkart or big 3PL, a third-party logistics company, you are using equipment called very narrow aisle forklifts or VNA trucks.
Right.
These machines go up 12, sometimes 14 meters high to stack pallets. It's like 4 or 5 stories. Now imagine a forklift mast that is 14 meters tall. If the floor is the very bottom is off by just 3 or 4 millimeters, a tiny bump you wouldn't even feel walking on it, that tiny variance amplifies all the way up the mast.
Oh, I see. It's simple geometry. A small tilt at the bottom becomes a huge swing at the top.
It becomes a huge swing. By the time you get to the top of that 14-meter mast, that 3 millimeters at the base has become a 10 or 12 centimeter sway.
Wow.
And if that mast sways 10 centimeters, it either smashes into the expensive racking system, or worse, it can drop a 1-ton pallet on someone's head. Or, if you're using robotics, the robot sensors detect an uneven surface and it just tips over or shuts down completely.
So you literally cannot run a modern automated supply chain on a grade B floor.
It's binary. It's not a nice to have, it's a must have. Either you have an FM2 floor and you can lease to a top-tier tenant like Amazon, or you don't, and you're left leasing your space to a local trader to store grain. The rental premium for grade A is often 30–40% higher purely because of this efficiency.
And I assume the height matters too. You mentioned 12 meters.
Yes, it's all about volume.
Yeah.
Old go-downs were maybe 4 or 5 meters high at the eaves. A grade A facility is 10 to 12 meters clear height.
Okay.
You, as a tenant, are paying rent per square foot of ground, but you are using cubic feet of air.
You're paying for the floor, but you're selling the sky.
That's a great way to put it. If I can stack 5 pallets high instead of just 2, my storage cost per pallet drops dramatically. The tenant is actually happy to pay a higher rent per square foot because their overall efficiency per unit is so much better.
It's like buying a plot of land and being allowed to build a skyscraper instead of a bungalow. The underlying cost is the same, but the utility is multiples higher.
Exactly. And that's before we even talk about other things like advanced fire safety systems, ESFR sprinklers, which stands for early suppression, fast response. Those can lower insurance premiums for the tenants. Or having enough docking bays so trucks aren't queuing for hours. Or having solar panels on the roof, which lowers the electricity bill. It's a total efficiency package.
Okay, so we've established that these are high-tech, valuable boxes. Now let's talk about where they are. In real estate, the cliche is location, location, location. I'm looking at the map in their investor presentation, and there is a very, very obvious skew.
The southern bias. You can't miss it.
Right. It says about 62% of their entire portfolio by area is in the south. We're talking Chennai, Bengaluru, Coimbatore. The west, so Mumbai and Pune, is about 21%. And then the north and east are much smaller portions. Is that a vulnerability? If I'm an investor, do I want to be that exposed to one specific region of the country?
It's a classic double-edged sword. It absolutely is a concentration risk, and we should definitely talk about that in the risk section. But strategically, it's also a powerhouse. Let's just do a quick deep dive on Chennai, for example. Why is Chennai so important in the logistics world?
Well, I know it's a major port city.
It's a huge port, yes, but it's also known as the Detroit of India. You
Oh,
have
yeah.
Hyundai, Ford, Renault, Nissan, Daimler, BMW. They all have massive manufacturing bases in and around the city.
The auto hub.
The auto hub. Now
Mhm.
think about the logistics of car manufacturing. It's not like storing boxes of shampoo. Car parts operate on a just-in-time or even just-in-sequence supply chain. The seat manufacturer needs to deliver the correct seat in the correct color to the assembly line exactly 4 hours before that specific car is built.
So the warehouse has to be physically close to the factory. You can't be stuck in traffic.
It has to be next door. If you own the warehouse that is right next to the Hyundai factory, you're effectively part of their assembly line. And that creates incredible stickiness for you as a landlord.
What do you mean by stickiness?
I mean, that tenant cannot easily leave. They can't just decide to move across town to save 5 rupees a square foot on rent. Moving a warehouse that is deeply integrated into a just-in-time manufacturing supply chain is a logistical nightmare. It takes months, even years, of planning. They are stuck with you.
So the southern bias is actually a strategic bet on the industrial and manufacturing base of India, which is
Yeah.
arguably stickier than, say, a generic e-commerce distribution center that could be moved more easily.
Correct. And then you have Bengaluru, of course, which is the other big southern hub for them.
Ah,
And that's all about consumption and tech. So they have this powerful mix of industrial stickiness in Chennai and consumption velocity in Bengaluru.
okay, that makes sense. But the risk remains. If a massive cyclone hits the Tamil Nadu coast, or if the state government suddenly changes its industrial policy, a huge chunk of the portfolio takes a hit. That's the trade-off.
That is absolutely the trade-off.
Okay, let's pivot from geography to the business model itself.
Hmm.
How does the cash actually flow? We know they collect rent, but what are the components? Is it just a flat monthly rent check?
It's a classic commercial lease model, also known as a triple net lease in some markets. It's a bit different here. Tenants sign long-term leases, typically for 5 years, 9 years, or sometimes even 15 years. They pay a base rent per square foot.
Okay.
But on top of that, they also pay for CAM common area maintenance charges.
Like an HOA fee in a condo building?
Exactly like that. The tenant pays for their share of the security guards at the gate, the lighting in the parking lot, the landscaping, the upkeep of the internal roads. The NVIT just manages it, but the cost is passed through. This protects the NVIT's margins from inflation in those operational areas. But the most important part of the model for an investor to understand, by far, is the escalation clause.
The automatic rent hikes.
Yes. These rental contracts aren't static. They're not flat for 9 years. Typically, they will have a built-in escalation of, say, 5% every single year, or sometimes it's structured as 15% every 3 years, which is mathematically similar.
Okay, stop there. 5% a year. If inflation in India is running at 5% or 6%, aren't they just treading water? In real inflation-adjusted terms, the rent isn't actually growing.
That is a very sharp observation, and it's a critical point. In a high-inflation environment, a fixed 5% escalation is actually a drag. It barely covers inflation, you're right. However, the real rental growth, the real alpha, doesn't come from that annual escalation. It comes from the mark-to-market opportunity when the lease expires.
Explain what mark-to-market means in this context.
Okay, let's say you are a tenant and you signed a lease 5 years ago at 20 rupees per square foot per month. With 5% annual escalations, maybe today you're paying around 25 rupees.
Mix.
But over those same 5 years, because of huge demand, new roads, and general inflation, the actual market rate for a new lease in that specific area have gone from 20 rupees up to 30 rupees. When your lease ends, the landlord doesn't just renew you at 25 rupees plus another 5%.
No, they reset it.
They reset the rent to the prevailing market rate of 30. That is a 20% jump in your revenue from that one property overnight.
Ah, okay. So the 5% escalation is just to keep the lights on during the lease term. The real money is made at the renewal event.
Exactly. Provided, of course, that the market rate has in fact gone up. If the market crashes and the rate is now 18 rupees, you have the opposite problem. You have a negative mark-to-market. But generally, in a structurally growing economy like India, this mark-to-market potential is the hidden growth engine of the portfolio.
This brings us perfectly to the idea of the moat, the competitive advantage. We've talked about the high-quality buildings and the strategic locations. But what stops a well-funded competitor from just buying the plot of land across the street and building a nicer, newer warehouse and poaching your tenants?
That is the perennial risk in all of real estate.
Yeah.
Supply. And it's a real risk. But NDR has a very specific structural moat that's hard to replicate. It's what I call the sponsor flywheel, or more technically the ROFO.
ROFO.
Right of first offer. Here is how it works. Developing a warehouse from scratch is incredibly risky. Buying land in India is, well, it's an adventure. You have to deal with dozens of farmers. You have to get the land use converted from agricultural to industrial. You need environmental clearances. You have to deal with local politicians, zoning issues. It can easily take 3 to 5 years to turn a dirt patch into a rent-generating warehouse.
And an NVIT, which is owned by public unit holders, generally doesn't want to take on that kind of development risk. They want steady, predictable cash flow.
Correct. So the sponsor NDR warehousing does all the dirty work. They take the construction risk, they fight the bureaucratic battles, they fund the development. Once the building is finished, and this is the crucial part, once it is fully leased to a good quality tenant and is generating stable cash flow, the NVIT has the first right to buy that finished asset.
So the NVIT gets to essentially skim the cream off the top. They buy the finished, de-risked asset without ever touching the messy development part.
Yes, it provides them with a secured, predictable pipeline of future growth. They don't have to go out and hunt for deals in the open market and compete in bidding wars. They have a buffet of high-quality assets being prepared exclusively for them by the sponsor. The documents say they have a pipeline of over 5 million square feet just from this.
But hold on, I'm going to put my skeptic hat back on here. This sounds great in theory, but isn't it a massive, glaring conflict of interest? The sponsor and the NVIT are basically related parties. What stops the sponsor from building a warehouse in a terrible location that no one wants, and then forcing the NVIT to buy it at an inflated price just to bail themselves out of a bad project?
That is the classic related party transaction fear.
Yeah.
And you're absolutely right to be worried about it. It is the #1 risk in this kind of structure. If I'm the sponsor, my incentive is to sell high. If I'm an NVIT unit holder, my incentive is to buy low. So who wins that negotiation?
Exactly. Who's looking out for me? The little guy.
This is where the governance structure and the SEBI, the Securities and Exchange Board of India regulations come in. SEBI is very, very strict about this. First, for any major acquisition from the sponsor, the NVIT is required to get at least 2 independent third-party valuations for the asset. You can't just make up a price.
Okay, that's a good check.
Second, unit holders often have to vote to approve major acquisitions, so there's a democratic check. And third, and this goes right back to our earlier point about InvestCorp, do you really think a sophisticated global investor like InvestCorp would just sit by and quietly watch the sponsor dump junk assets at inflated prices into the trust they've invested in?
Probably not. Their reputation is on the line. That's where the institutional backing acts as a powerful watchdog.
Yes, exactly. InvestCorp's presence on the board and as a major unit holder suggests that the governance rails are strong enough to prevent that kind of abuse. But as an investor, you absolutely have to watch the acquisition price and the yield of every new asset they buy. If they start buying assets at a yield that is lower than their cost of capital, that's a major red flag.
Okay, that makes sense. Let's talk about growth. We have the ROFO pipeline, which is their inorganic growth engine, buying assets from the sponsor. But what are the macro drivers? What is happening in the wider world that makes these boxes more valuable every year?
2 words, quick commerce.
Zepto, Blinkit, Instamart, the 10-minute grocery delivery wars.
It's a global phenomenon, but it's on steroids in India, and it completely changes the physics of warehousing. In the old days, e-commerce meant 3 to 5 day delivery. For that kind of timeline, you could have your giant warehouse 50, even 60 kilometers outside the city where land is dirt cheap.
Because you had 3 days to get the package from the warehouse to the customer, a long drive didn't matter.
Right. But if you promise delivery in 10 minutes or even 30 minutes, you physically cannot be 50 kilometers away. The laws of physics and traffic make it impossible. You need your inventory to be on the periphery of the city, or in some cases, even inside the city limits in what they call dark stores.
You need urban logistics, the last mile.
Exactly. And urban land is incredibly expensive and scarce. This creates a massive scarcity premium for any well-located warehouse that is close to a major consumption hub. NDR's portfolio, especially in places like Bengaluru, Mumbai, and Chennai, is perfectly positioned to capture this trend. As delivery times continue to compress, the rental value for these last-mile or near-city warehouses just skyrockets.
So our collective laziness, our desperate need to have a bag of chips and a Coke delivered in 8 minutes, is directly driving the rental yields of these industrial trusts.
It is. We are willing to pay a premium for that convenience, and that money flows right down the supply chain to the landlord who owns the strategically located real estate. The data backs it up, too. The reports we saw project the Indian warehousing market to grow from about $58 billion this year to over $100 billion by 2030. That's a huge tailwind.
Fascinating. Okay, we've painted a pretty rosy picture so far. Strong sponsor, growing macro demand, high-tech assets, a clear growth pipeline. Now I want to tear it all down. Let's shift gears and look at the risk framework. What are the failure modes? What kills this investment?
The biggest, most immediate risk is what we can call the expiry cliff.
The lease expiry cliff. I saw this in the presentation.
If you look at the data, for FY 2025, they have about 11% of the portfolio's leases expiring. That's, manageable. But then you look out to FY 26 and FY 27 combined, it's nearly 27%.
That is a huge chunk. More than a quarter of their entire revenue is up for grabs in a 2-year window.
It is a massive variable. Now, a moment ago, we talked about the mark-to-market opportunity, the chance to hike rents significantly at renewal. That's the bull case.
Right.
But you have to consider the bear case. What if, in 2026, the Indian economy slows down dramatically? What if a major tenant like Amazon decides to consolidate its operations and doesn't need that much space anymore? What if there's a sudden oversupply of new warehouses in the Chennai market?
Then you have empty boxes, and an empty box doesn't pay rent.
And an empty warehouse is a financial disaster. It's worse than zero revenue. Not only is the revenue gone, but you still have to pay the property tax, the insurance, the security guards, the maintenance. It becomes a cash drain. So if they can't renew that 27% of leases at good rates, or if a significant portion of it sits vacant for 6 months, the distribution per unit, the DPU, the dividend you get as an investor, will drop. It has to.
So FY 26-27 is the binary event to watch.
Right.
If they navigate that renewal cycle well, it could be a massive windfall for unit holders. If they fumble it, it could be a crisis.
Correct. It is the single biggest execution risk on the horizon. You are betting on the strength of their leasing team and the health of the market 2 years from now.
Okay, what about interest rates? We've been in a high-rate environment globally for a while now. How does that affect an NVIT?
That's risk number 2. NVITs are extremely sensitive to interest rates, and it hits them from 2 different directions. One is the obvious one. They borrow money. NDR has debt on its balance sheet. If interest rates go up, their interest expense goes up, and that means there is less cash left over at the end of the quarter for you, the unit holder.
Simple math. And reason 2?
Reason 2 is a bit more subtle. It's about opportunity cost, or what investors call the yield spread. If I can get a completely risk-free 7.5% return from a Government of India bond, why would I buy a warehouse trust that yields, say, 8%? That extra 0.5% spread just isn't enough to compensate me for the risk of a tenant leaving or a cyclone hitting.
So for the NVIT to be attractive, its yield has to be significantly higher than the risk-free rate.
Exactly. So if government bond rates stay high, it puts a natural cap on the unit price of the NVIT. For the price to go up, they either need to increase their distributions or they need interest rates in the broader economy to fall, which makes their existing yield look more attractive by comparison.
It's a gravity problem. High rates are like a heavy weight that pulls down the price of all yield-bearing assets.
That's a perfect analogy. And then there is the perennial Indian risk, the one that never goes away: land.
You mentioned earlier that buying land is an adventure. Let's dig into that a bit more. Why is it so difficult?
Because land ownership in India is incredibly fragmented. If you're a developer and you want to build a 50-acre warehouse park, you are almost never buying that 50-acre plot from one single seller. You might be buying 1-acre plots from 50 different farmers, all part of the same extended family.
And you need all 50 of them to agree to sell.
You need every single one. If 49 of them say yes, and the one guy whose plot is right in the middle of your plan site says no, or demands 10 times the price everyone else got, your entire project is stuck. You have a donut with a very expensive hole in the middle.
I can see how that would be a nightmare.
There's a whole cottage industry of people called aggregators, whose entire job is just to go and convince 50 different farmers to sell their land. It is messy. It involves litigation, family disputes, lost property records from 100 years ago. It's incredibly complex.
And this impacts the NVIT how? Through the pipeline.
It impacts the ROFO pipeline directly. The sponsor might say in their presentation that they have a 5 million square foot pipeline coming online by FY 27. But if they get stuck in a nasty land dispute in Pune, that 5 million square feet becomes zero for the next 3 years. The growth engine just stalls.
So the sponsor flywheel can get jammed by one stubborn landowner.
Or a sudden change in local zoning laws. Or an environmental clearance that gets delayed for years. It's the friction cost of doing business in India, and it's a real risk to the growth story.
Okay, let's look at the financials. That's section 6. Given all these risks, is the balance sheet healthy enough to survive a downturn or a delay?
Actually, yes. From the numbers we've seen, its financial profile is currently quite conservative. The key metric everyone in this space looks at is net debt to gross asset value, or debt to JV. For NDR, it's currently sitting around 18.3%.
Is that high or is that low? What's the context for that number?
It's very low. The regulatory cap set by SEBI is 49%, so they are less than halfway to their regulatory limit. And technically, they can even go up to 70% with certain strict disclosures and credit rating requirements. So being at 18% means they have massive headroom.
They have a war chest of debt capacity they can use for acquisitions.
A huge war chest. They can borrow a lot of money to buy more warehouses from the sponsor without having to issue new units and dilute the existing shareholders. And on top of that, their credit rating is AAA from CARE.
And AAA is the best you can possibly get, right?
It is. It's the gold standard. It means the rating agency believes the risk of this entity defaulting on its debt is virtually zero. And what that means in practical terms is that they can borrow money at the cheapest possible rates in the market. If they were rated, say, BBB, their interest bill on the same amount of debt would be significantly higher, eating into distributions.
Okay, let's talk valuation. This is always the tricky part. How do we even begin to value something like this? It's not a tech stock, so a PE ratio is completely useless.
Absolutely useless. Don't even look at it. The only way to properly value an asset like this is with a DCF, a discounted cash flow model. We project the rental income for the next 15 or 20 years, you factor in the escalations, you subtract all the costs, and you discount that stream of future cash back to what it's worth today.
Standard stuff. But there's another concept I want you to explain. In the reports, they talk about cap rate compression. It sounds technical, but it seems really important. Can you break that down?
Yes. This is the concept I want listeners to really grasp because it's where a lot of the value can be created. The cap rate, or capitalization rate, is effectively the yield an investor expects to get on a property. If you buy a building for 100 rupees and it generates 8 rupees a year in net rental income, your cap rate is 8%.
Simple enough. Income divided by price.
Exactly. Now imagine the perception of the Indian real estate market changes. Imagine global pension funds and insurance companies decide that Indian warehousing is now a safe haven asset class, similar to how they view warehouses in the US or Germany. They might look at that building and be willing to accept a 7% return instead of an 8% return.
Because it's perceived as being safer now, the risk premium has come down.
The risk premium has come down. Now, if the rental income is still 8 rupees a year, but the market now only demands a 7% yield, the math says the value of that building must rise. 8 rupees of income divided by a 0.07 yield is roughly 114 rupees.
So wait, the building went from a value of 100 to 114 just because investors felt safer about India.
Exactly. Without laying a single new brick, without raising the rent by a single rupee, the underlying asset value of the portfolio jumped 14%, purely because the cap rate compressed. That is the holy grail for institutional real estate investors. Part of the bet on NDR is a bet that as the Indian market matures and becomes more stable, cap rates will compress towards global levels, driving up the NAV, the net asset value of the trust.
So it's a bet on the maturity of the Indian financial ecosystem just as much as it's a bet on the physical buildings themselves.
Precisely. You have two levers for growth, rental growth and cap rate compression.
All right, we are in the home stretch. For the listener who is thinking, okay, this is interesting, I might buy this, or maybe I already own this, what should I be tracking? Give me the 12-month KPI watch list. What are the 3 numbers we should check every single quarter?
3 things. You can stick them on your fridge. Number 1 is renewal spreads.
Okay, so that's the rent hike they get on that 11% of the portfolio that's expiring this year.
Yes. When they announce their quarterly results, they will publish a number called the releasing spread. Does they manage to release that space at a price that was 5% higher than the old rent? 15% higher? Or, and God forbid this happens, did it go negative because the market was weak? A positive spread proves the investment thesis. A flat or negative spread kills the growth story.
Crystal clear. What's number 2?
Acquisition pace. They've guided in their presentations that they plan to acquire roughly 2.01 million square feet of assets from the sponsor soon. Well, does soon happen? Do they actually close the deal? InvITs live and die by asset accumulation. If 6 months pass and we hear nothing on the acquisition front, you should be skeptical. Execution is key.
And number 3.
Debt cost. This is a simple one. In their reports, they state their average cost of debt. With a AAA rating, it should be very low and very stable. You just need to watch that number. If you see it starting to creep up quarter after quarter, it means their margins are getting squeezed by the interest rate environment, despite their good rating.
Renewal spreads, acquisition pace, and debt cost. Clear, simple, and actionable.
Those are the simple, vital signs for a complex business.
Okay, before we sign off, I want to leave our listeners with one final, perhaps slightly more speculative thought. We've talked about cash flow, about DCF models, about concrete and steel, but there is a potential hidden value here that isn't captured in any spreadsheet.
The land bank optionality.
Exactly that. Look at any major Indian city. Let's take Bengaluru. 15 years ago, a place like Electronic City was considered the absolute outskirts. It was way out there. Now it's basically the middle of the action.
Cities are living, breathing organisms. They expand, they constantly swallow their own periphery.
Right. So the warehouse that NDR owns today, which is currently sitting on the edge of the city,
Hmm.
what about in 20 years? That location might not be an industrial warehouse location anymore. That might be prime residential real estate.
Or a new IT park. Or a shopping mall.
Exactly. The highest and best use of that piece of land might change dramatically over time. And if that happens, the value of that land isn't based on warehouse rent anymore. It's based on residential per square foot prices, which could be 5x or 10x higher.
That is the ultimate wild card. The DCF models we talked about value the asset as a warehouse in perpetuity. But for the ultra-long-term holder, you are effectively sitting on a massive, strategically located land bank in some of India's fastest-growing cities. That is the ultimate inflation hedge.
A potential treasure chest buried deep under that super flat FM2 flooring.
I like that image, yes.
Well, we have covered a lot of ground, literally and figuratively, from the tax reforms of GST to the physics of forklift masts, the financial engineering of InvITs and cap rates. NDR InvIT is more than just a stock ticker. It's really a lens into how the physical landscape of India is changing.
It's the plumbing of the new economy. It's not sexy, but it's absolutely essential.
And sometimes the unsexy stuff makes for the most interesting deep dives. Thanks for unpacking all of this with me today.
My pleasure. It was a good one.
And to you, the listener, thanks for tuning in. Don't just take our word for it. Look at the renewal spreads, watch the geography, and as always,
Keep digging.
keep digging.